Welcome to the daily update, where I'll go over the action in the market for Friday, October 11th, and then we'll see how things look for Monday, October 14th. Set another new all-time high with the Dow and S&P 500. The banks came out with their earnings and they were taken as positive, and that really helped the broader market to see some buying coming in. But the NASDAQ and NASDAQ 100 and tech and growth really didn't participate in the upward move in Friday's session. But the fact that we're setting an all-time high is positive in and of itself. It seems like the market just does not want to go down in spite of the warning signs that we're seeing, like the Hindenburg-Ullman, the potential for weak seasonality, because that's historically what happens. We want to be aware of those things because they can come into the picture at any time. But I've been saying this for a few weeks now, and we're just not seeing it. But we want to know about these things anyway. It's better to know about something and not have it come about than to not know about something and get caught off guard. Okay, so I do have a thing called the SPX Investing Program. It's up, it's going, it's free until the end of 2024. I go through additional videos that I post there. I go through some ideas for trades in the short, intermediate, and long term. If you want to check that out, you're free to do that. Please click on the description below this video. You also get early access to the daily and weekly videos. And some folks like that because the daily video is designed to be viewed before the market even opens, or at least before the market closes. Because the way I teach the strategies in the program, we do things based on the close, not on the open, not what happens during the day. We initiate new positions as close to the close as possible. So you can still watch the video while the market is open. Where the videos, I delay them on YouTube and Rumble before they become public. Also, the daily video, it's the real hub of the analysis that I do. Now that it's the weekend, I'll be preparing all the outside videos, but they're meant to feed into the daily video. Okay, let's go back and talk about what happened and then look at some charts. We had pretty much a flat open. PPI came out and the market didn't really react to it all that much. But then we just saw some buying coming in. Prices climbed above R1 at 57.95, and then we broke above 5,800. We got up above R2 at 58.10, and then we just held that spot. We didn't really see a lot of selling coming in. We didn't see additional buying. We just kind of went up there and sat. So it held on to the gains and chopped above and below R2, and then we ended up closing above R2. We were up 0.61%. We're still below average with volume, which is a concern when we're starting to go to the upside and we're still seeing volume really tapering off. We have to follow price. As I always say, that's the ultimate indicator is price. No matter what any of our charts are saying, we have to go with what price is doing. We look at volume to get some clues as to what is actually happening more internally. And then we do have the holiest day of the year, according to Judaism. That's currently happening as I record this. We'll have to see if that's going to escalate anything in the Middle East. There's a lot of talk going back and forth between Israel and Iran and what's going to happen next and when is it going to happen and how are things going to play out from there. Oil isn't really reacting. The stock market really hasn't reacted to that, but that could always change. Some comments. Both the Dow and S&P did set new all-time highs. Small caps had a pretty good day, but they haven't broken out of the range. They just went up, and we'll see what happens after this. And the NASDAQ and NASDAQ 100 actually lagged. They were not performing as well on a relative basis in Friday's session. Bank earnings were taken as positive, and that really helped give some stimulus into the market going higher. And we're keeping an eye on what's happening in the Middle East. Oil's still right around that $75 level. And we have pretty much all of our usual charts now on the short-term list, which you could say is overextended to the upside, but at the same time is showing good momentum. We have the Stochk RSI, the Williams Percent R, the CCI 14 and 20, the stochastics, and now the boom indicator that measures how far away are we from the 20-period moving average. That's looking just barely extreme right now. And in the intermediate term, the Arun actually kicked into gear and is giving us an extreme positive reading. The PMO studies, it's been on the list for a while. The Sean trend meter, which actually declined but is still extreme. The bullish percent index for the S&P, which didn't move all that much. And now the 100 period moving average study. These are stocks inside of the S&P that are above their 100-day moving average. And then longer term is the 10 period new highs, new lows for the S&P, which is looking really solid, but has been looking this way for quite a while. Looking at the long term, we still have our 150 and 200-day simple moving averages that are looking solid. And now we have the exponential moving average that I'll show you in a moment here. That's getting just barely extreme positive there. I haven't made any changes to the scenario because the market seems to like how things are unfolding right now, that it looks like they're going to be coming in and doing more cuts. And I'll go over that in the weekly video where we look at the probabilities of what the interest rates will be at the next two meetings. And the idea of the soft landing still seems quite plausible for the time being, and the market likes that. The dollar was down slightly after it really roared up this past week. It's still in a downtrend, but it really bounced up. And interest rates were also down. We came down to 4.07%. So we're still above 4% where we had been at 4.10%. We're still inverted with the 10 to the 3-month yield curve where the 10 to the 2 remains uninverted. Sentiment, we're getting close to that 75 level. Now, there's nothing really magical about 75. It's just a point that we look at to say, okay, when we're at 75 or above, we're getting a little too positive right now as far as sentiment, where we were starting to drop back a little bit. Well, we had been at 71. We closed at 74 on Friday. So we're getting kind of close. We want to keep an eye on that. Our trend is still positive. We're above the moving average. The green line's on top, and we're above 20. So we're in a confirmed positive trending environment, both in the short and intermediate term. With the update, our bias is positive, and now I've changed our momentum back over to positive since we've been able to break out of that range that we had been in for a while. The reports that came out, we had PPI come in unchanged, where they expected it to be up. Last time it was up 0.2%. The core PPI came in as expected, so the market liked that, where last time it came in up 0.3%. Consumer sentiment came in at 68.9. They expected it to come in at 70.1. And last time we saw it at 79.1. So here is the chart, the year over year look at PPI. The total, it's down below that 2% level, where the core is going up a little bit here above that 2% level. And then final demand year over year, looking at goods in blue, we're seeing a decline. Services, we're seeing the yellow line going up. And that's more indicative of the US economy now. It's more services based, where 60, 70 years ago, it was more manufacturing based. And so we're seeing the yellow line going up as the blue line is going down. Intermediate goods year over year, processed are coming down and unprocessed are also declining, and both are below zero. Here is our chart, just showing the rate of change going back over the last 12 months, where we're seeing a decline. We're also seeing the rate of change going down on a month-over-month basis. And here's the core PPI, where we're coming up just a little bit on a year-over-year basis, but declining on a month-over-month basis. Here is the consumer sentiment. First, we look at the blue line, which is showing a bit of an improvement here. That's the total reading, and that's the chart that we look at. And then how people are feeling right now is purple. That's seeing a little bit of an improvement. And then expectations going forward, people are feeling a little more positive as well with that. And here is our chart where we actually tick down just a little bit here. So we're seeing a little contradiction on this. And then plotted on here is the 2-year Treasury yield, where it has been coming down, but over the last week or so, actually a couple of weeks, interest rates have been going back up more. So looking at some Isabel Net blog charts, this is from Real Investment Advice. This looks at earnings estimates and compares it to the S&P, where they have a real strong tendency to move in the same direction. And this is looking forward at the forward-looking earnings, like that we also measure by looking at the PE ratio looking forward as well. It's coming down just a little bit here, but you see a real close correlation between the two on a year-over-year basis because it's ultimately it's earnings that drive stock prices either higher or lower. And then looking at small caps, and I have a version of this chart that I show in the intermarket analysis video and also the weekly video. I show a weekly version of this. Even though small caps had a really good day on Friday, they're still really underperforming when you compare them to the S&P. And we see little spurts here with the small caps, and then they fall back, and then another little spurt up, and then they fall back. Well, overall, on a ratio basis, small caps continue to underperform. Then here's the your euphoria meter. Okay, it's kind of hard to say that. Where here we have the S&P on top, which is in black, and we're starting to see a little bit of exuberance here, maybe getting a little too happy about things. When we look at the forward PE ratio, the VIX, which is kind of strange that it's giving such a high reading here because the VIX is quite high right now. It's not very low. And then bullish sentiment, they take that together, and this could be a bit of an issue. Now, another time we had a similar reading to this was right at the end of the dot-com boom that went into the bust. Now, I'm not saying that's what's going to happen now, but I'm not saying that either. So we just want to keep an eye on how the market it does not like to be taken for granted. And when people just start throwing money thinking, oh, it's just going to double, it's just going to go up, that's about the time when the market comes in and starts to reverse. But we're not seeing any confirmation of that, at least yet. And then the spread between the VIX and the 10-day realized volatility, it's widened a little bit here. This is just showing that there's not a lot of fear right now in the market. And then implied cash allocation by non-bank investors on a global basis. People are putting their money in the markets where they're not really going into cash right now. So we're seeing that really coming down. Profits and payrolls hysterically or historically are correlated. This is the payrolls that we see in the light blue. That's what we had a week ago. And then you look at the ISM manufacturing, which they have a tendency to move in the same basic direction, and that's what we're seeing right now here. And then this is on a world basis. This is looking out with the forward PE ratio and then earnings per share revisions, where they had been going up, and now we're starting to see them coming down, and they're actually decoupling from each other a little bit here. So we'll want to keep an eye on this, but we're still looking solid with the US anyway, and I'll be going over that again in the weekly video, how we're looking as far as earnings. But maybe the rest of the world is needing to catch up a little bit there. And then debt allocation, it's at 20%. These are folks through Bank of America that actually have bonds as part of their portfolio, and we call that debt. Didn't spend any time on Twitter, not really much going on there these days, at least as it applies to what I try to show in these videos. But here we had pretty much a flat open, and then buying just came right in. We quickly went above R1. We got up over R2. That became support as we were leveling off here. There was an attempt to take things lower, but then we came in here to the volume-weighted moving average, and that seemed to provide some support. I don't use this blue line all that much. I kind of look at it, and if we're above the blue line, that's more positive. Sometimes it'll act as support or resistance, and if we're below the line, then that's seen as more negative. That's really what I use it for. Just like the volume, price by volume here, I don't rely on this really heavily. It would be cool, but the way this chart is calculated, it only displays the price that you see on the chart. So it's not really giving a true indication of the volume at a particular price. So I like to have it on here, but I really don't look at it all that much. Here's our intraday chart, just showing how things really were pretty much flat until after the open, and that's where we saw a lot of the strength coming into the market. And we're seeing growth in value on an intraday basis pretty much even with each other. Value was the real winner in Friday's session, and growth had been showing some improvement where the blue line's above the red line. But with value really going up in Friday's session, they're pretty much matched, even though they're on different scales here. And not seeing really any follow-through strength, at least yet, with the S&P growth to value ratio intraday. Going back to the beginning of October, we were seeing a gradual improvement. Now, we did pull back on Friday. Are we going to be able to turn and go back up here? Or is this giving us a little bit of a warning sign that, okay, If growth continues to go down, that could be more negative for the indexes. Here's our end of day chart where growth was up, but a lot less than value. Value really had a good day. Growth was up strong for the mid caps, but up less than value. It was up a little bit more with the small caps. So here's our end of day chart looking at the small cap growth to value. A little bit of an improvement here, but still a longer term downtrend. We were pretty much flat to slightly declining with mid cap growth to value, also in a downtrend. And this is the area that's looking a little bit better. S&P growth to value ratio, where we're coming out, we broke above this previous high, even though we didn't have a really solid session on Friday. We look at the growth versus value ETF, we're still inside of the rainbow, not really showing any strength there. Discretionary to staples, the ratio is still looking pretty good, but it's not so much that discretionary is doing well. You can see it's kind of chopping sideways. And Tesla just got hammered in Friday's session, and I'll show you that chart later. It's more that staples have been pulling back, and that's what's been helping the ratio to really go up. Large cap growth still looking good, and looks like possibly setting a new all-time high there and above all of the plotted moving averages. So even though growth didn't have a really solid day, it was still up 1/3%. Looking at the condition of the trend, we're seeing the ADX above the moving average. We're above 20, so that is a confirmed trend. And we're positive because the green line is above the red line. Also seeing a very similar thing here with the short-term ADX. Above the moving average, the green line is going up, the red line is going down. Volume continues to be below average, which is a concern, but can also be kind of a secondary concern. When I first started learning technical analysis back in the early 90s, you always wanted to see a confirmation. If you saw an increase in volume as we were going up, that was confirmation. If you saw price going up and volume going down, that was a negative divergence there. And that's what we're seeing right now. But we've been seeing that for a while, and it doesn't seem to really matter at this point. But it could change at any time. Even though we declined with the VIX, we're still above 20, and that is a warning sign that we're seeing. We're also coming down a little bit, but still above the moving averages when we look at the VIX of the VIX, both with the bar chart and the line chart. The momentum of the VIX is rolling over a bit, but the momentum is still up, and that's negative for stocks. And we're still wondering, where are we in this whole scheme of things? We're kind of matching up more historically with what the VIX is doing. We're just not seeing a follow through with stock prices, because usually when the VIX is going up, that means stocks are going down. We're still getting a pretty high reading here with the VIX to S&P 500 correlation. We're above the dashed line. This is the third day now that this has happened, and this just means that the market is getting nervous. Hasn't seemed to matter, at least to this point, but at some point it could come into play. And we're also getting a high reading, even though it's declining slightly with the skew index. We're up in this red area where the market is still expecting some kind of a big move. And apparently the upward move that we've seen is not what the market was expecting. So that's why we're still in the red area here. So this could potentially be negative for the S&P, but it's been this way for about a week, and it hasn't seemed to really matter. And we went up with this fear gauge where we declined with the other fear gauge. So we're seeing some contradiction with these charts. Not much of an improvement, actually a little bit of a decline when we compare risk on to risk off. But for the most part, this ratio has been going up, and that's more positive for stocks. We saw a real drop off in the equity put call ratio, which is, if you try to put logic into this, you're not always going to come to a good conclusion. But you would think, okay, there's tension in the Middle East. It's a weekend. The bond market's going to be closed on Monday, and people are not hedging ahead of the weekend because we see a real drop off in the put call ratio here. You would think this would go up, but it's actually really going down. They might have been hedging against CPI and PPI and then taking those hedges off, and they're not really concerned about what may happen over the weekend. So we're still going down and getting extreme here with the 5-day equity put call ratio. And this just gives you more context where we're below this level. Now we could still go much lower than where we're at right now. But when we drop below this green line, that means we're getting extreme. And that can often mean a top in the market. But we've seen that a couple of times before, and it hasn't really come into play, at least yet. And we're starting to go back down with the 10-day, but we've been pretty choppy with that moving average there. We're still getting a very high with volatility risk premium, which in this context could end up being more negative for stocks. Our advanced decline line, we are just barely breaking out and setting an all-time high, at least matching the previous high here with the advanced decline line based on price. We are setting a new high here with the advanced decline line based on volume. So that is pretty solid there. And we did see a breakout of the new highs, really no expansion of the new lows, but our 5 period is still going sideways to slightly declining. We're flattening and trying to turn up again here with the 10-day moving average. So internally, we're looking really good with the S&P. The accumulation distribution, still above an advancing moving average. We could be getting a little far away from the moving average as measured here by the boom indicator. And we're still above zero with the 19 and 39-day advanced decline ratio. That's positive for the short and intermediate term. This is a further breakout where we're positive based on price with the advanced decline ratio, also positive based on volume, and seeing a little bit of an improvement with the Chaikin money flow, but the red line is still going down. The histogram did go up from Thursday to Friday, but we want to see this a little bit more than what we're seeing now. And this below average volume is a bit of a concern, especially when we're setting an all-time high with the S&P and this indicator is going down. That's a negative divergence. But we're seeing a bit of an improvement here going up with the Chaikin oscillator. So that is still positive. And the vortex, okay, setting an all-time high with the S&P and the green line goes down. But on a positive note, the red line also went down. So we're still positive here. And we're seeing more of a matchup again. We were seeing a bit of a disconnect between the S&P and the NYSE advanced decline line, even though they're on different scales. They're more matching up with each other right now. We look at the advanced decline line for the S&P 500 based on a cumulative method here. We did not set a new all-time high based on price, but we did set an all-time high based on volume, which has been positive up to this point. Will it continue to be positive that volume is actually leading price and looking stronger than price? We look at the new highs minus the new lows, we get a positive answer. We're still ticking down just a little bit here with the 50-day moving average. Still getting a very high reading with the 10-day moving average of the highs and lows for the S&P. And actually, it's trying to turn back up just a little bit here with the 50-period moving average. It was really hard to see on the other charts. And with the cumulative advanced decline line for the NYSE breaking out to an all-time high, but not breaking out to a new high here with the NYSE advanced decline line. Also positive with the other NYSE advanced decline line, but not breaking out to a new high. When we break this out based on common stock, we have not surpassed this previous high where we are setting a new high with the advanced decline line based on volume. So again, this is another idea that within the S&P, that's more narrow, even though it's a broad market benchmark. But even broader is the common stock on the NYSE, and the fact that volume is leading price higher could be taken as positive. And here's the new highs, new lows for the NYSE, getting a positive result there. The 50-day moving average is also declining a bit, but is still above zero. And then we look at another broad market measure of a 5-day moving average of the highs and lows, still coming down here, but still above zero. And we look at the ratio between large caps and small caps, it declined because small caps had a better day than large caps. The advanced decline line looking good here, going up, but not setting a high yet with the NYSE common stock, pretty much matching the previous high with the S&P. The mid caps are turning back up, and the small caps, after coming down to the moving average, did bounce back up, but have a ways to go to surpass these previous highs. And those stocks above their 20-period moving average in the S&P, we're still looking positive here since we're above 50. And we're looking positive with the 50-day moving average study, and we're starting to get extreme with the 100-period moving average study. That's more intermediate to somewhat long-term. And we're going back up, but not extreme with those stocks above their 200-day moving average. So taken together, this is looking pretty solid. Short term, nothing really other than to show you that we set a new all-time high here, but look how volume, and it's not only below average, it's dropping more as we were going up with the S&P. And so that's just something we're concerned about. We're seeing a bit of an improvement here with the 20 and 50 period moving average study. The 200 is just barely closed at 81, so it's looking a little extreme positive there. And all of our short-term charts here. The Stochk RSI is now extreme, as is the Williams percent R, the CCI 14 and the CCI 20. The stochastics in the short, intermediate, and long term are all looking extreme now. We are positive and above the midpoint with the force index. The condition of the 20-period moving average, we're above both the green line and the blue line, closed above that. That's still looking pretty solid there. We're above both the simple and exponential 20-period moving average, also looking pretty solid. I'm not even showing the 50 and 100 and 200-period moving average studies because we're so far above even the 20-period moving average right now. In fact, maybe a little too far. The boom indicator is saying that we're just possibly getting a little far away from the 20-period moving average. Looking positive with the 50 and kind of chopping sideways, but still positive with the 200. And this measures the distance we're either above or below a particular moving average. Right on the border between the +2 and +3 channel with our standard deviations chart. When we get overextended, as if we go up into the +3 channel. Intermediate term, looking more positive with the balance of power, we're above zero. The condition of the 50-period moving average, we're above the red line and the blue line. That's positive. The go, no go still has the darker blue, which is positive. We're starting to see the blue line for the highest high value go up, so that's positive. But the TTM squeeze continues to decline. It's darker blue and declining after it had been extreme positive there. And turning up a little bit, still positive, is the ease of movement. And the Arun shot up a little bit in Friday's session. We're getting to an extreme reading. And this looks at the buyers on here, which is denoted by the green, and the sellers, which is denoted by red. And the oscillator just measures the difference between the two. And it's starting to get extreme positive here with the oscillator itself. We're just barely negative with the S&P McClellan oscillator. We're still coming in at a minus 0.13. So whenever that's below zero, we continue to decline with the summation index based on price, but we're starting to turn up based on volume. So a bit of a divergence here, which could be taken as positive if we see follow through with volume going up and possibly price turning up after that. But we've been led astray by this before, so we just want to be aware of that. We're improving, but still negative with the NYSE McClellan oscillator, so we're still going down based on price and volume. Looking better here in one aspect, with the Swenlin trading oscillator crossing back above zero, so we've gone from negative to positive there. But to have an up day like we saw and see the Swenlin trading oscillator flat, even though it also bounced off zero, and is still positive there. But you'd like to see these confirming each other, and they're not doing that, but it's still positive when taken together. Trying to show some improvement here with the momentum. The PMO is trying to turn back above its moving average, but we're still declining based on price. We're flat based on volume. Seeing a little bit of an improvement with the PMOs that are rising. The buy signals are starting to go back up, and we're declining here, but still extreme with those PMOs above zero. Again, setting an all-time high, and to see this going down, little bit of a negative divergence there, but we have to follow price. We're still positive with the Elder's Impulse system when looking at the S&P, and we're positive for the third day now with the parabolic SAR. We're trying to turn up, but still negative with the slope oscillator. The MACD is actually crossing above its moving average again, so that's turning positive. So we're seeing a bit of a mixed picture here with the slope trying to turn up, but still negative, looking a little more positive in the short term with the TSI. The MACD, the PMO, and PPO trying to turn up as well, but we're flat with the tricks, and we're still negative with the KST, longer term oscillator. And the Copic curve continues to be negative, and we're above 50, pretty much flat, but still positive with the money flow. We're above 50 and going up with the ultimate oscillator. On-balance volume is still positive above an advancing moving average. We declined with the Sean trend meter, but we're still extreme positive. We're above all of the plotted moving averages here, and we're seeing all of the lines going up. So that just shows the short, intermediate, and long-term trend continues to be positive. Not much of a movement here with the bullish percent index. It's still extreme positive, and it went up a little bit, but we're getting a very high reading here now, and that's often a concern to us. Still looking pretty solid with the NYSE bullish percent index, a very high reading there, and showing a little bit of an improvement and positive with the NASDAQ 100 bullish percent index. Above 50 and going up with the RSI 14, that's intermediate term, also going up in the short term with the RSI 9. And this is a weekly chart just showing how we closed at the high and we're above this R2 pivot point. So long term, we're still looking quite solid. And on a trending basis, the Heiken Ashi has open candles. That is positive. The Kegi is pointing up and is black. That's positive. The Renko has open blocks. That's positive. And the three line break, after it had been looking a little more negative, is now turning back and looking more positive. Long term, still looking really solid with the 150 and 200 as both of these moving averages are going back up. We're positive across the board with the Keller market model on all time frames and all indexes here. Negative still in the short term with bonds based on price. And we're still negative with commodities in the long term. The dollar, which is now in a positive trend in the short term, is still negative in the intermediate and long term. All of these sectors ended up being up except for discretionary. It ended up, and a lot of that had to do with Tesla down, what was it, over 8%, almost 9%. I guess I was calling it robo cab, but apparently it's robo taxi. Apparently it didn't make quite the impact that they were hoping for. And everything was pretty much positive right out of the gate here with Canada setting an all-time high, the Dow setting an all-time high, the S&P, we got above 5,800, the Nasdaq out above 18,300, but we're seeing discretionary dropping below 70 with its BPI. So that's coming down. And again, a lot of that has to do with Tesla. Seeing more of a coupling here with the weighted version versus the equal weight version of the S&P. And a little bit of a decline here as the mega caps and the really big companies and semiconductors didn't have quite as good a day as the rest of the market. The Dow is just setting a new all-time high here. We're positive with the Elder's Impulse system for the diamonds. The Nasdaq was up 1/3% and trying to break out above this recent high, but still has a ways to go to get back to the all-time high set back in July. Nasdaq 100, kind of the same thing, was up 0.15% and still has a ways to go to set a new all-time high. But positive when you look at the QQQs with the Elder's Impulse system, the momentum for the Nasdaq 100 is now turning back more positive. And here are the small caps. They were up 1.78%, but just coming up into the higher end of this range that they've been in. We had come down close to the 50-day moving average, and we were able to bounce above that and get above this pivot point too. So that's positive. And we've gone from negative to positive with the Elder's Impulse system for the small caps. Then we look at the Russell 2000 small caps, going back above 50 with the RSI, still above the 50-day moving average. The momentum is improving, but still negative. And the mid caps finally trying to break out a little bit above this range that it's been in for the past few months. It was up 1.61% and going from neutral to positive with the Elder's Impulse system for the mid caps. Did set a new all-time high here with the Wilshire 5000, a broad market measure, also setting an all-time high with the total U.S. stock ETF. So that's quite positive. And we're still going down with the staples to tech ratio, but the longer-term trend of this ratio is that staples are outperforming tech. If we can continue to fall and eventually see this roll over and give a death cross, that would be more positive for tech. Financial sector looking really solid, up 1.93%, setting an all-time high. The FANG index was up 0.01%. So we have the big companies, Facebook, Apple, Amazon, Netflix, Google, Nvidia, really didn't participate in Friday's move up. And we're still below this shorter term trend line. We're still above this longer term trend line as the FANG index figures out what it wants to do. Apple was down 0.65%, but still above its 50-day moving average. Amazon was up over 1%, looking pretty good now. Microsoft, we're watching to see if there'll be a death cross here in the near future, but we're not quite there yet. Google also came down to its 200-day moving average and so far has been bouncing above that as well as its 50-day moving average. Meta was up over 1%, but not setting an all-time high. Nvidia was virtually unchanged, still above its 50-day moving average. And Tesla down 8.78%, dropping below its 50-day moving average. Netflix was down over 1% after setting an all-time high. And we're seeing a real disconnect here in the short term between US stocks and world stocks. As the short-term correlation is dropping, we're still hanging in there fairly well with the longer-term correlation between the two. Oil is still right around the 75 level, not much of a change in Friday's session. And the dollar is still in a downtrend. It was down in Friday's session, but it really had a solid week. And we're continuing, for the most part, to go up with the 10-year yield, even though we dropped a little bit in Friday's session. So we were up a little bit here with the 10-year based on price. And looking at the growth to value ratios, coming back down to the moving average with the Qs to S&P. And discretionary, again, when we look at discretionary to staples, that's looking solid. But when we look at discretionary to the S&P, it's now really starting to come down below its moving average. We saw a little bit of a drop, but still above the moving average when we compare large cap growth to large cap value. So the large caps coming back down to the moving average, mid caps doing pretty well these days, and small caps looking pretty good as well. Can we see some follow through, which has been elusive in 2024? We did go up a little bit with the S&P to utilities ratio because the S&P was up and utilities were down. But overall, we've been seeing this ratio declining overall. And this is positive too, where the Staples to S&P ratio continues to decline. That's positive for the S&P. Just an update here, the Hindenburg-Ullman, no additional confirmation, at least yet. We're still working off of the same confirmation that we saw, well, a month ago now. So what's our outlook for Monday? The bond market will be closed on Monday for Columbus Day. And we're still positive when we take all of our technicals together, but we still have this Hindenburg-Ullman, a weak seasonality, and these VIX signals. But the market doesn't seem to care about those, at least yet. And we want to keep, I guess we're not going to have anything on Monday. I didn't update this. There's no economic reports coming out, but we want to keep an eye on the geopolitical events. And then Tuesday, not much. We're going to get the NYSE Fed Empire State Manufacturing. And Wednesday is going to be kind of a light day. So Thursday is going to be the big economic report day with jobless claims, retail sales. I think industrial production and capacity utilization is kind of a big deal. And then on Friday will be housing starts and building permits. And here's a look where they're only highlighting what will come out on Thursday as far as being important. Seasonality, though, when you look at October 14th, it's positive across the board. People like Columbus, apparently. So, all right, go for it. Go discover a new world. We will be on the 10th trading day of the month, where we're not seeing an awful lot of positive seasonality here during an election year. Kind of flat to slightly declining when you look at that. Monday, at least in 2023, was the most positive day of the week. And it's a positive day, the third most positive day of the week in 2024 thus far. And we're just wondering if this negative seasonality is going to come in and matter at some point. So far, it hasn't. We do have a confirmed Hindenburg-Ullman and weak seasonality, which hasn't seemed to matter. We're watching staples, utilities, and healthcare. Energy more for geopolitical reasons. And we're watching growth to value, discretionary to staples, which is looking solid, but discretionary by itself is not doing all that well right now. We're looking at multiple VIX signals, which taken in context is more of a warning sign than looking positive. And we're going up with the 10-day. Actually, we're back to going down here. I didn't change that. And we're looking a little bit better here with the S&P and NYSE McClellan oscillators. The volume is going up with the S&P, but all else is still going down. And we're seeing a divergence with the Swenlin trading oscillator. Volume is positive, but it was flat in Friday's session where price actually went up. And our oscillators, they're mixed right now. They're trying to improve, but they haven't switched over to all being positive at least yet. And the copy curve is still negative. So the positive signs, seeing some improvement with accumulation distribution. Chaikin money flow, that's a little bit of a concern to see it go down on an up day. The Chaikin oscillator is looking a little better. And this is where we're actually positive here with the 5-day going down, but we're getting extreme with the 5-day. When we look at the equity put call ratio, the advanced decline lines are looking good. We're still extreme with the bullish percent index for the S&P, but we're positive with the NASDAQ 100 and NYSE bullish percent indexes. Parabolic SAR is now positive. The Vortex is positive. Money flow, ease of movement, and ultimate oscillator. And the momentum for the NASDAQ 100 is positive. And the financial sector had a good day on Friday and continues to be positive. So our conclusion, we're positive. We still have this Hindenburg almond, which could stay around for a while before it actually turns into something, or it may not even turn into anything, but we still want to be aware of it. And we're still seeing these VIX signals. In the short term, you could say we're overbought, but you could also say we're showing good momentum. Intermediate term, this is where we see the confirmation of these signals that are giving us some concern, and we're becoming a little bit more extreme positive right now. You could say overbought or good momentum, and we're still overbought in the long term, but we remain positive there as well. Thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.